There we go. Let's go.
Cool. Okay. So, thanks for coming to the four of you. So we're going to run this one a little bit different. So I'm also going to talk a little bit less about the news, more about Gonzal's trading account, and then also I'm going to do a quick stock pitch to you as well. Show you how to sort of navigate the Hargreaves Lansdowne website. They're basically a stockbroker, and they've got quite a lot of useful tools on their website to make things easy for you guys to look into companies a bit further. You want to start with your trading account, right?
Yes.
Yes. So Gonzal's going to start with his trading account, which is real money. It's really interesting.
Great. So, what can we do when we move from fake or virtual money to real money? So, one, I'm going to talk to you about a way with equities, but kind of a conservative way, which, I mean, it's nothing to do with buying Tesla or trying to benefit from what the Tesla share price is doing or trade with Bitcoin or anything like that. No, it's about trading with investment funds, which if you do it properly, it's kind of a conservative and a good way of trying to earn money. So, first bullet point that I have there, problems with the number of funds that the platform offers. First, in my opinion, I don't know if Matt knows something else, but in my opinion, there is no platform that has absolutely everything. So you have kind of a basic bank account with a trading account with a news Bloomberg type thing. Yeah. So I don't think there is any platform like that. So as with Exante, for example, we put the trades, the trading platform, but then to do the research, we can do it either in the Bloomberg terminal or on the FT website. So there is no one big platform that does everything. So in my case, I've got my normal bank account with HSBC, and I have there as well the trading account. So what I mean by this is that, for example, HSBC has at around 400 different investment funds.
Does everyone know what we mean by investment funds? Okay, so when we invest in, say, like Barclays, we're investing in that company. When we're investing in an investment fund, we're investing in, say, a Barclays investment fund. We're investing in a fund that Barclays has set up. So they basically take our money, so we give them our capital, and then they manage our money, and then they're going to then invest it in other companies. So I don't think you three were here for last term when we spoke about the Ruffer investment, but Ruffer's an investment company, it's like 300 million pounds assets under management. That company invests in real estate in China. Off the top of my head, I think it's got a stake in. What's it stake in? It's got a stake in some in Apple. It's well, stake in the big boys as well. It's also got stakes, owns bonds and that sort of thing as well. So it's not just you invest in a company. Whereas what Gonzal's saying here is that we're looking at investing in investment funds because we're also allowed to do that as part of financials. There's arguably a lot less risk involved in this because there's a lot less volatility. So basically, Gonzal's saying is that. And also as well, you can't just use one platform to get all the information you want. He's now going to talk to you about Morningstar and how to navigate that for us to try and find investment funds for us to put into our portfolio.
Okay, so if we go to this website, we see here 60,000 investment funds, but here we have all sorts of funds. I mean, pretty much everything about equities, bonds, and then inside equities and bonds we have all the asset managers, which you can see not here. Yes, in here you have all the asset managers, and then here are all the categories. So I mean, could be Forex, could be emerging markets, then in different currencies, Europe, UK, global, USA. So, if I go to my HSBC account,
so those funds are they specialise in those certain things. So the Forex fund, just like the guys in the Forex team, they're just doing Forex. So and then the world equities ones, they're investing in world equities, basically exactly what it says on the tin. But so in that Morningstar thing, we can select can you select financials, Gonzalo?
yes.
So so for us, obviously we're financials, we can select financial funds, yeah.
So 99.
Yeah, so there's 99 for us to choose from on Morningstar. And obviously like a sort of potential strategy to look at the return of all these 99 different funds and then decide which one we want to invest in. Obviously you need to remember that past returns doesn't necessarily suggest future returns though. Yeah.
Just a second.
So
okay, so now we are going to see that this HSBC platform only offers 400 investment funds. Just a second. Where is my investment? Oh, come on. Where is my investment?
Gonzalo's a very wealthy man.
Yeah.
I'm sorry, guys.
I have to apologise for your unsuccess.
Yeah. We can't all be like you. We're all poor students, Gonzalo.
No, yeah, we're gonna have something done that I can't.
So does HSBC has its own trading platform?
Yes.
Yes.
So that's like obviously Exanti. So we're using the demo account for Exanti, but obviously Exanti's also got a real trading platform as well. So Gonzalo basically uses the HSBC one. I think his point here is that there's loads of platforms out there and they all show different things. The one that I'm going to go through later on when I talk through my investment opportunity at Rathbones, that's using a different platform called Hargreaves Lansdown. There's loads of them out there.
How do you choose your platform?
Good question. I think a lot of the time people just go with what they know, but I think cost is a big thing as well. So the transaction cost, yeah. And obviously like the larger platforms have more sort of equities and bonds on them, so they're more attractive as opposed to some of the smaller people.
I have a question.
Sure.
Why do we have stocks like in Wall Street or here in the old money leaves if we can do this online?
Why do we have like a stock exchange, like a central place? Well, because when we're buying stocks, we're not actually. So we buy it off a broker. So there's sort of an intermediary there. So what happens is I say to HSBC trading division, I want 100 shares in Apple, and then HSBC trading division don't just give me that straight away. They then have to go to the stock exchange. So they have to go to like the London Stock Exchange. Obviously, it's all like online or whatever. So they have to go to like the London Stock Exchange or the New York Stock Exchange. So Apple, they have to go to the NASDAQ, which is like another exchange, and then they have to then find someone that they can then buy those 100 shares off, and then they buy those shares at X price, and then they then sell them to me at whatever price. And then the difference between the two is like the spread, so the bid-ask spread. So that's how they make money. So that's why you sort of have a central exchange for everyone to like come together, for the buyers and sellers to come together and then exchange the different stocks.
Okay.
Yeah.
So also cannot just go directly into the exchange.
Well, yeah. So when you're like buying a share in a company on here, it's not like they don't. Well, they might have like an inventory of stocks already. They might already have a few shares in Apple to sell to you, but it's not like it's not as simple as just buying it. Like, you've got to find someone to buy it off.
Okay.
There's only a fixed number of shares in every company. That's what sort of these like demand and supply and go up and down, because if people want it more, then the price goes up. Yeah? You struggling, Gonzalo?
No, I cannot access it. I don't know why.
Do you want me to go into my pitch whilst you play around with it?
So
Or?
it'll be my wealth dashboard. at the top.
So yes, here it is.
Okay.
Thank you, Max.
No worries.
Okay, so I'm going to carry on.
HSBC here.
I don't even have an account for HSBC. They rejected me of getting an account.
Oh really?
So here we have trade funds, which this is only one part of what you can get from HSBC. Then you have another platform to buy or sell shares. So 462 funds, and the same we have different asset managers, a lot less than on Morningstar because they have some kind of agreements in between HSBC and the asset managers, so the asset managers offer the funds on the HSBC platform, and categories as well, so China, Europe, different categories in pounds, global, so all of this. So that is one of the things that we have to be very careful, because I mean the more funds we have to choose, the better the possibilities that we are going to find a good fund. So we need to be careful, because I mean the offer is much lower than the big offer of Morningstar. Then I'm going to the next bullet point. Yes, sector, country, growth, value. Do you want to explain, Matt, what a growth stock or a value stock is?
Yeah. So a growth stock, simply growth. So you start expected to grow, so you've got the revenues growing. Often it might not be particularly like established in the market, whereas sort of the value stock. So actually, I don't want to talk about that much because
you're going to talk about.
I'm going to talk about my presentation on the pitch. So I'll get that because the whole point of my pitch is that it's a value stock.
So, for example, a good example of a growth stock is Apple.
Yeah.
And a good example of a value stock is McDonald's.
Yeah.
Something like that.
So, in fact, so you know we have our investment in UniCredit. I'm not sure if you guys remember us talking about that last term. So that's considered to be a value stock because its price to book ratio is half. So that's like the price that you're paying is like, so you're paying like say £1 for it. The price to book's the price to book's 0.5. So to get one of its book value, which is like all of its tangible assets, so in a bank tangible assets, then you only have to pay like 50p to get access to all of those assets. If that makes sense. Does that make sense? No? Okay. We'll come to the ratios when I do my presentation on the Rathbone. Basically, after Gonzalo's gone through this, I'm going to pitch to you Rathbones, who are an investment management company based in London, and there's a couple of ratios on there. So when we come to that, I'll explain that. Yeah.
Okay, so we carry on. Imagine that we want to buy an investment fund that is invested in technology shares. So Facebook, Apple, Amazon, all of them. So we click here, we apply filter, and okay, fair enough. We have only one investment fund, so let's go for this one. Probably there are more. 26. Okay, so this is UK equity. Now, what do we do? How we choose the best investment fund out of these 26? So there are various things. Thank you, Max, for coming.
It was a nice presentation. Enjoy.
There are various things that we can analyze. The first one is that the investment fund has to have at least 4 or 5 stars. Where do we have the stars? HSBC gives us this information, but we can have this information as well on Morningstar. These stars go from 1 star, which the fund is not performing well, to 5 stars, which is that the fund is performing well with respect to the index that the fund is tracking and with respect to its own category. So if we go to HSBC, here we have these 26 funds of maybe different asset managers. So how do we know which one is doing the best. So we compare them between these 26 funds. So we compare them with the FTSE 100, which is the index that these funds try to beat, and in between them. So with those two, we more or less know if the investment fund is doing well. More.
So you know when we're looking at returns of something, like if say a company, the stock price has grown by 20% this year, do you think that's good?
Sorry?
Do you think it's good if share price has gone up by 20%? Yeah, so yeah, it's good, but
there is a big but.
Yeah, but there's sort of a big caveat to that.
It would crash.
No, well, I guess it could be, but that's what I'm getting at. So what I'm getting at here is, so if one share, so you buy a share now, it's gone up 20%, you think, great, I've made 20% this year, that's really good. The whole point here is like, if every other company, whose share price has gone up by 30%, it's not actually that good, because compared to like the benchmark, like you could have done better by investing in, say, Google goes up by 40% or something.
Yeah.
So you're comparing to the FTSE 100, which is the benchmark, or the S&P 500, or something like that.
More.
Sorry,
yes.
all the stars, like all the websites, rate according to the same ratio?
No. Well, Morningstar's probably the main rating agency, isn't it? But so like you've got other rating agencies of stocks or bonds. So you've got like Moody's, Fitch. Moody's and Fitch are the same thing. S&P. So like, say if you like go here.
Go ahead.
Here now and just type in Moody's rating scale. So yeah, I'll show you this, like rating scale. So like Moody's, they also like rate. It's more like debt that they rate debt.
So you mean about this AAA?
Yeah. So like.
You mean that scale?
Yeah, it's more of a debt thing, I suppose.
This is for bonds.
Yeah, for bonds. But yeah, I guess Morningstar's probably the main one for like the equities. But here, look, so you've got like AAA is obviously the best, and then all the way down to C. Probably not actually that relevant for us, but sorry.
Okay, so next bullet point, we need to check again. I mean, what we are trying to do. I mean, you can just pick any of these, and if the FTSE 100 goes up, probably most of the funds will go up as well. But we are not trying to do that. We are trying to find the best investment fund amongst these 26. So one of the things, the stars, as we said, this one, the first one should be better than this one, and this one should perform better than this one. When we say perform, we mean higher return at the end of the year, for example. So more, we check that the investment fund has been trading for at least 10 years. What does that mean? That has some kind of track record. So they are not someone that are in the market for a year. They've got such an amazing return, but that doesn't mean anything. You need to have some kind of long history of doing a good job. Okay.
Yeah.
So how do we?
Sorry, yes. I would say be careful at that point on the 10 years. Like if you actually look into, it's not really a very good example, but this guy called Neil Woodford. I don't know if you've heard of him. He's like a big fund manager. So he went on his own and set up his own company in like 2013, 2014, and I think it was around then. So obviously that's not 10 years ago, but before then, before he set up his own company, he worked for Invesco, which are a big asset manager, and he's really successful there. So a lot of people put a lot of money into his fund because he's obviously got a good track record there. So when you're going to look at these like Morningstar and things and you see, oh, it's only been around for 1-2 years, look at who the fund manager is, and if it's somebody who's pretty well known. I mean, in Neil Woodford's case, his fund absolutely fucked up, so it's not a very good example, but just be careful looking at who's running it.
Okay. So yes, as I said, for example, there is one fund there, BNY Mellon UK.
Yeah.
That hasn't been in the market for at least 10 years.
Yeah.
So we would kind of discard that one. I mean, we would rely on the other ones. Then we can click in this 10 years and see which of the 26 funds have done the best. So there, I mean, that is the worst one, let's say, and the best one is, come on, oh, fair enough, this one, this Aviva Investors. So let's say that these 4 funds are good candidates to include in our portfolio, but we need to do more. That is not enough. What we are trying to do is to increment our chances of getting money. We are not talking about how much money we are going to earn. We are talking about incrementing the chances of earning money. Okay? I always say that in the market it's very easy to lose money and very difficult to earn money. So we do these kind of things so the chances, our chances of earning that money increase. Okay? Then check that the fund consistently beats the benchmark and the category. The benchmark is the index, for example, in this case, the FTSE 100. So if the FTSE 100 got 10% return last year in 2019, what did these funds do? Did they get 11%, 9%? So above or below the index that they are tracking. So we are looking for funds that got a return above the index. And then the category. First the index and then the category. If the category made maybe 11%, so 1% above kind of the mean of these 26 funds, if they made 11%, did our fund got 12, 13, 14, so 1, 2, 3% above the category? That is what we are looking for. Okay, how do we know that? There are various ways, but let's pick this Aviva fund. Something important that we need to know is this number in here. This is the ID, let's say, of the fund. So we go to Morningstar, we put that ID in here at the top, and we should have a lot more information about the fund than what the HSBC platform gives us. Okay, so here it is. We come here, and here we are going to see many more things about the fund. This is why we trade on HSBC platform, but we support that with another platform such as Morningstar or Bloomberg Terminal or the FT or something similar. So what we have here in this red curve, we have the fund. In orange we have the category, which is the category is what the 26 funds did, and then the green is the index. We can see here that both the fund and the category did worse than the index, which means in this case, and we can talk quickly about passive and active investments, that just tracking the index, I mean, we would have got a higher return just by tracking the index. So being passive, we mentioned that last.
Do people know the difference between passive
week.
and active?
2 weeks ago, actually.
Not really.
Okay, so like a passive investment, there's a lot of stuff about it at the minute, especially. So passive investment fund, you're tracking the market. So you can buy ETF, an exchange traded fund, that just tracks the FTSE 100. So it owns a tiny little bit. Like the fund is made up of a tiny little bit of each company in 100 companies, or S&P 500 tracker, something like that. So with that, there's very low cost to it because you've not got some person sat in an office somewhere looking into a company saying, is this a good investment or not? So it's pretty cheap. low costs for investors, and obviously tracks the market, so the market goes up, the fund as well. But then active investment is like you might only hold like say 10, 15 companies, so you could, or whatever companies they are, and you want to try and beat the market by owning shares in those companies. But to obviously be investing in those 10, 15 companies, whoever it is in whatever office is doing a lot of analysis into those companies before they decide, right, they're good companies to invest in or not. So obviously they charge a higher fee for doing that because they're trying to beat the market. Does that make sense, or is there any questions? Yeah? But like at the minute, we've sort of, there's been a big rise at the minute of like passive management, and today, I don't know if you read about it, two big active managers. Is that active managers? Yeah. Yeah, two passive managers I've merged today. Who is this merged today? Who knows who's merged today? Anyone know? Two big companies, I can't remember if they're passive or active now. These guys, Franklin Templeton. Oh, you're not logged in.
Sorry about that one.
Franklin. I can't type on this computer. Templeton. Basically, so these two big asset managers, well, one's buying the other, was announced today. Oh, I don't know. Essentially, at the minute, there's been a big rise towards passive management with the likes of BlackRock, Vanguard, State Street doing these sort of big investment funds in passive, because there's so many active managers at the minute that are failing at actually beating the market, and people are realising that it's not actually worth the cost. Actually, so you know how you asked earlier how to decide which investment platform to use? This is why it's sort of good to know, like to shop around. So if you go like, I'm just going to get this as an example. So on Hargreaves Lansdown, so they're a broker.
Do they offer everything?
No, not everything. They've got, so through them you can buy this, is it what it's called, Total Return? Yeah, the Total Return Fund. It's just some random fund, forget what, it's not relevant about what fund it is. But look here, so because Hargreaves Lansdown have got this relationship with this company called Ruffer, normally the charge, if you got it directly from Ruffer, it'd be 5%. Like so,
which is huge.
Which is massive, yeah. So if you buy £100 worth of shares, you're just going to get charged 5%, which you lose that straight away. But because Hargreaves Lansdown have got a special relationship with them, you get a 5% saving, so there's no charge at all.
Okay.
And then they've got this performance fee here as well, which is 1.22%. But obviously that's based on what's this? Yeah, ongoing costs associated. That's an ongoing charge. So that's just a charge. There's no performance fee. Sorry. There's an ongoing charge to it, but there's no initial charge because you've got this big saving. Whereas, I don't know if HSBC have this fund on their platform, but you might have to pay that 5% there.
Most of them are only 1.5, 1.25 without the initial cost.
Yeah, what do they mean by saving?
Huh?
The saving. What is it?
Oh,
Initial saving.
sorry, what? Sorry, I'll go back. What do they invest? What, this company?
Initial saving.
Oh, so that's just saying that that's the saving that Hargreaves Lansdown give you. So they give you a 5% saving, which then makes it 0%. So there's no initial charge.
Okay.
5 minus 5 is 0.
Okay.
Yeah. Okay. Are you still on your thing?
Yes, I'm going to finish off in a minute. Okay, so next we go for check rank in category. So let's see how good this fund is with respect to its peers. So here we have these numbers are quite important. This is, first you are top, so you did the best, and 100 you did the worst with respect to your investment fund peers. So here we see that this fund has been doing more or less all right. It's not something amazing. You cannot see here any of this year that the fund was at top 5, but here we look for maybe higher numbers. So this is quite important. Then something important as well is these numbers here. These numbers, one is with respect to the category, and the other one with respect to the index. So if the index got 10% return, this got 15.98, and this so these returns above, I mean the positive ones above the index and the negative ones below the index. So we are trying to look in these values here each year to be positive. Okay, because if they are negative, it means that they did worse than the index or and the category, its category. So those things here are important to carry on finding the best fund.
And how about the ranking?
The ranking.
Percentage rank. How do you ensure this?
This ranking category.
Yeah.
It's something that I don't know how it works, but imagine if we see here a good example.
Does it have to be low or high?
No, this one has to be the higher the better. So the closer to 1, the better. So here we can see, I mean, maybe that might not be a very good example, but here we have that in 2 years, the fund, in this year, in 2018, the fund did worse in both category and index. So it was, yes, the 52nd position, so not very good. And the best one was this year, for example, or last year, that it got 4% above the index and the category, so it goes higher, if that makes sense to you guys.
What's the difference between the two?
As we said, the category, imagine, is among the 26 investment funds that we saw that invest in the same index, which one did better or worse. I mean, yeah, that category is with respect to its peers, so to the same funds. And that category index is with respect to the index, with respect to the FTSE 100 in this case. Did you understand it?
Yeah. Thank you.
Okay.
Good.
So
I think I'm going to finish it, because then we can plot the performance of the funds and see how they did in 10 years in between them. But anyway,
so yeah,
we
basically
will leave it here.
the point in, guys, I'll show you this, is that just gives you guys a bit of a introduction to how you can find some investment funds if you want to then invest in them yourselves or pitch them to us in a meeting. Does anyone have any stocks they want to pitch today? No? Okay, that's fine. I'm not going to go through this now because I want to be able to get through this, because I mean that lady's going to be coming back in a minute to kick us out. To kick us out at 15:15. So we've got 15 minutes.
Okay.
So basically, I'm going to pitch to you Rathbones. Rathbones, there's a lot of text on that side actually. Basically, they're an investment management company based in London. They do discretionary management, which is like active management as opposed to passive. So obviously, there's been a lot of declines in share prices across active managed companies companies are actively managed because there's been a shift towards passive. Basically, this company, as you can see here, if you look at the blue line, so this is like the simple moving average. Do you know what the simple moving average is? So basically, like, it's over 50 days, the simple moving average here. So it's sort of like the average share price over that 50-day period. So it moves. So like, say if you just do a 30-day one because it's easier. So it'll be the average share price from the last 50 days from, like, say today, and then like if you looked at it from 2 months ago, then it would be the 50 days prior to that and the average price of that. So obviously, if it's the average is going down, then the share price on average is going down. Like, so say you could have here, you've got a huge spike here, but obviously the average, because it obviously only came up for like a month, then it's not really done. Obviously, it's a slight uptick in the simple moving average, but it's not really like as pronounced. So this company has been declining a lot. However, my sort of opinion is that So we're £90,000 ahead of TMT. I've not spoken to Gonzalo about this, but this is what I was thinking. So we're £90,000 ahead of TMT, like £100,000 ahead of Forex. But we're £100,000 now off consumer, the other sector. So we're pretty far back. So I'm thinking maybe now's the time to take a few risks, like this one. Could pay off, it might not. And sort of to mitigate those risks, we can put a stop loss on. Do you remember what a stop loss is?
No.
Okay, so stop loss is, so we buy the stock at 50 quid, and then we can put a stop loss in at £45. So if the stock price falls to £45, this automatically sells it for us. So we don't end up having to lose any more than £5. Whereas if we haven't done that, the share price could plummet to literally 10 quid or something, and then we'd be stuffed and we've lost like 40 quid. But if we have a stop loss, then if there's a huge decrease, then we're covered.
Can you do that in real life?
Yes.
Yeah, you can do that in real life.
But
You-
who would buy it though?
Huh?
Who would buy it? Like, let's say.
Because
market
people always want to buy
absorbs,
stuff.
yeah.
Because everyone's always got different opinions, and people are always wanting to buy things. Because obviously, if the share price is falling, then people might think, "Oh, that's really cheap. Let's buy that." And I think it was going to go up in the future. There's always someone that wants to buy something.
Yes.
That's a stop loss. And then the opposite of that is I could take profit. So we could put a take profit on at £55. So when it hits 55, we sell it as well. So then we've made our 5 quid. Because what could happen is in a day, it could go up to 55, and then it could come back down to 51 or something. So then we could have made a fiver, but then we've then lost that £5, and now we've only made £1 if we sell it. So it's sort of like locking in your gains or limiting your losses.
For locking, do you do it like on the platform? Like, is there a system?
Yes.
Do you want to show?
So on the platform here, right, so say, well, this might as well do the company that we're talking about, Rathbone Brothers. So we've got this stock here, Rathbone, and we can drag it over here. So, I don't like how this is laid out. So then we want to buy however many, here we go. So we want to buy, say, 100 shares in it. So we put quantity 100. Now if we go up buy market, that's buying it. But here you've got TP, take profit, SL, stop loss. So we can do TP, price. So you can then put our take profit on it as, say, 25. So if it goes up to 25, we then cash in our gains. Or stop loss, price, put that at, say, 15. If it drops to that, then it sells it to, and then click buy market, and then we're done.
And the stop loss is something really, really important
Yeah.
that anyone should put on each of their trades.
Yeah.
I mean, yeah, it doesn't make sense to stop the gains.
Yes, I mean the stop loss makes a lot of sense. The take profit, I mean, of course, you can do it, but yeah, you can see it as not a very clever thing to do, but I guess it is clever at some situations, in some situations, not always.
I mean, we haven't really put any take profits on because
No.
I'm sort of monitoring this most days so I can see what's happening. So if something's had a big increase, then I can just sell it then.
A stop loss always makes
Yeah.
sense. It take profit few times makes sense.
Yeah. Okay, so yeah, back to my pitch. Okay, basically this company, so it manages 50 billion. So as I was saying earlier, so that's people's money like yours or mine or your parents or whoever. They've given their money to Rathbones, and then they're now investing it in whatever, Apple, McDonald's, Cafe Nero downstairs, something like that. I don't know. Basically, but this amount that they're managing has gone up by 14% over the past year. So the more people are giving them their money to say, right, there you go, sort this out, invest it, and then obviously they take a fee for that. Current share price is 1,966, which is £19 because everything's in pence in share
I don't
price.
know why that is in the UK. It's so frustrating.
Last year they acquired a Scottish independent wealth manager as well, so that sort of increased their assets under management as well. Okay, so basically now, if I just go into this, so if you go Hargreaves Lansdown, which is this sort of broker that I mentioned, so Hargreaves Lansdown, then you can go funds or shares. So you know how Gonzalo's on about funds, you can also do funds here too, but you can go shares. Then we'll type in the company we want. So let's say if you've read something on the FT that such and such a company are doing something at the minute, you think, right, that could be a potential trading opportunity. You can come here, look at it, Rathbone Brothers. Then
Is this a fund supermarket as well?
Yeah.
Okay.
And then if you don't really understand what the company is, you can go company info. Be careful with this though, because it's not always completely accurate. Like here, it's just 29 billion British pounds, which is wrong, as we know. It says basically what they do, where they're based, dividend dates, who's running them. It's in the FTSE 250 on the London Stock Exchange. Market cap, so it's like big-ish but not huge.
Oh, the icing, which I forgot to. I didn't remember the name of the ID of the fund.
So
or
this is
share
the
price
so
is the icing.
Yeah. Okay. What else do I want to discuss? Okay, that's the company info page. Okay, and then here, what you can do is you can go charts and performance.
That's a really good website.
Thank you. So here's the share price, right? So we've got, so it was up at 2280 a year ago. You can change the years at the bottom, so if you want it per day, week, year, 3 years, 10 years, whatever. And you can add like different indicators onto here. So, you know, I was talking about the simple moving average, so like the average share price, you can do 20 day or 50 days, so I can do 50 day. That's what I showed there. 200 day, it's obviously going to be a bit more flat because it's an average over a longer period of time. Then you can show other things like dividends, which is a sort of a big one, or broker forecasts. So does everyone know what a dividend is?
Yeah.
Yes, it's when you're going to get paid like share their profits. So an ex-dividend is when they announce what the dividend will be.
Okay.
And then paying a dividend is when that dividend is actually paid. And then BF for broker forecast is when someone like these guys, Shore Capital. So you've got research banks or companies that say this is a good company and why you should buy it, or this is a bad company, don't buy it because and why. So at this point, October 2019, Shore.
Provide this information for free.
This is all for free, yeah. But normally, like to get that full report, so why Shore Capital have rated that down,
You need to be a client.
you normally need to be a client. But moving on to what I was also going to show, if you go to news on this, is quite good about Hargreaves Lansdown actually. If you go onto news, they've collated a lot of stuff from broker reports that they've paid for, and they obviously paid to make it public. So if you go here, RBC upgrades, Royal Bank of Canada, RBC, they rate companies. There's a whole report here on why they think what they think about where the share price is going to go, whether to buy or sell. And there's loads of this stuff on here, like broker roundup, just about funds rising and what's going to happen to the share price. It's really good.
The
So-
model for all this, right? Is it the fund managers that write it?
This
The
stuff.
analysts
It's like
inside
it's-
the asset managers.
Yes, this is analysts for other companies that are then saying you guys are good or you guys are shit, basically.
Oh, so it's like basically like Credit Suisse trying to write out for the other listed
Yeah.
companies.
So, but like Credit Suisse will like write broker reports on Apple, and like, there'll be analysts who literally most of what they do is just look into Apple and think, I think it's good, I think it's bad. Like
I mean, looking into their earnings,
Yeah.
fundamental analysis, and all of that.
doing all sorts of stuff, and then someone like because it's sort of a bit weird. It's sort of weird to think about it because Rathbone, they are the investment managers, so there's people writing reports on them, but then they're also using other people's reports on other companies to then decide what to invest in. Yeah.
Yeah.
So it's sort of like they're all using each other's reports on like whatever. Okay, so
Oh, sorry.
So
Is
go
this company also a fund that manage?
Yeah. So Rathbone, they have funds within their company that you can obviously buy. So I could go and buy it now if I wanted to. But also you can buy shares in the company as well. So I'm suggesting that we buy shares in the company. So obviously it's more to do with if the company as a whole is doing well. Because they have other services as well, like financial planning, things like that. So it's not just about the fund that's invested in does well. So in theory, if their funds do well, like they go up in price, it will affect the share price because then more people will flood into buying those funds. But it won't directly. That's more of an indirect effect. It's not going to directly affect us because if we bought the fund and the fund does really well, then we have gains because the price has gone up, right? Whereas now it's more indirect because more people will buy into those funds, and then they'll get more fees, and then we'll make money that way. Yeah? Okay. So basically, a little thing that I noticed is always good to look at, to try and see if you can spot like little trends. Basically, I charted the dividend dates over the past 3 years, and if you look, after the dividends, not there is much this one, but here, there's a lot of volatility. Like in comparatively, I mean, there's volatility everywhere, but there's always so ex-dividends, when they announced dividends, fell, and basically, and I mean, it's pretty stable over the past, like 4 or 5 months. So I know obviously there's a lot of risk involved in this trade because share price is pretty volatile. However, the next dividend isn't till the 18th of April. Yeah, 18th of April. So to me, and that's after when the fund's concluded, because we're closing this whole thing on the, I don't know the exact date, end of March. So hopefully it shouldn't really affect us too much in that sense. Have I covered everything I wanted to say? Yeah, so can mitigate the possibility of stock falling further with a stop loss, which we've spoken about now. Dividend dates. Okay, here's just like a bit of a summary of stuff from the broker notes. So RBC, Royal Bank of Canada, they upgraded them. They see a value opportunity, so it's a value stock. So you get like a lot of sort of price to earnings. So it's like you get a lot of earnings for your money. That's basically the sort of reason behind it. It's like the theory. So if here, look, 2020 price earnings ratio of 14.7, that doesn't really mean that much on its own. But when you're comparing that price earnings ratio to the FTSE 250, it means a lot. So that's quite a low price earnings ratio because normally Rathbone have a higher price earnings ratio, 18% average premium over the last 5 years. Is everyone following me? So normally this price earnings ratio is higher, but at the minute it's lower. And they're basically saying, RBC, that PE has rarely been at or below parity with the FTSE 250. And when it has occurred, it has resulted in a share price rally.
Oh, nice.
So hopefully there'll be a rally with that. Does everyone understand what I'm saying there?
What is a share price rally?
So share price rally is just boom, 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 go up. Everyone happy with like price earnings ratio and all that sort of stuff? Yeah?
When it's below the FTSE 250, means that it's making a loss?
No, it doesn't mean it's making a loss. It just means that relative to its peers, so relative to the other companies, its ratio is lower. And basically what they've noticed at RBC is that normally their ratio is higher, and when it does happen to fall lower, it normally the price normally goes up. Yeah.
Kind of try to spot historic patterns.
Yeah.
More than if a PE above or below is good or bad.
Yeah, exactly.
I think here they are also trying to get people to invest in
Yes, I mean,
like promise them to have higher price.
Yes, I mean.
What so you're saying that people like RBC want them to think that it's a higher price? Is that what you're saying?
Yeah.
The thing.
They announce this information to get more people to invest in.
Well, no, because they're not. It's Rathbones, the company we're investing in. They're not the ones releasing this information. It's another bank that looks into them and says, "We've noticed this about this company," and like, there's sort of.
It was the same company.
No. Sorry.
RB.
Yeah, no, sorry. That's a bit confusing actually. Rathbone Brothers and RBC are different companies. RBC are a separate company looking into them. And like there is a lot of sort of controversy sometimes about brokers, the possibility of brokers being in their interest to say you should buy this company or you shouldn't buy that company, because obviously they get money from that. But you've got to think about the credibility of them. Like if they give a really bad tip and say it's going to go up a lot and then it doesn't, then they lose their credibility and they're going to lose business in the long term.
So they try to make good predictions.
Exactly. Quickly some key risks. There's a lot of like wealth management companies out there, so the likes of Brew and Dolphin. That's sort of a good point. when you're doing an investment pitch, always you've got to don't ignore the risks. Like you've got to acknowledge the fact that they're there. Otherwise, it's not a very good pitch. Then their fees are under constant pressure from the likes of the cheap index tracking funds. They're the passive funds that I mentioned. There's a report saying that investors are unlikely to take risks with their cash in such an uncertain geopolitical and economic climate. So that's basically saying that their funds under management, it could end up falling if investors like you or me, whoever, don't want to be giving our money away to companies like Rathbones to invest it for them. Although I'd argue the market's getting a bit better in a minute, people are getting a bit more confident. And also their wealth management arm, so what makes up most of their revenue, is pretty mature business, so it's going to be hard to find like organic growth. Anyone know what organic growth is? Okay, so organic growth is like just your sales going up because you're selling more. You say like Asda, your sales go up because you're selling more of something. Like Asda, Morrison's, whoever, supermarkets, yeah? Whereas inorganic growth is like Asda's sales have gone up because they've bought another supermarket. So it's saying that the sort of only way for Rathbone to increase their sales is to start maybe buying other wealth management companies, which is what they did last year with the Scottish wealth manager. So to me that suggests that a lot of confidence in the directors, that they know what they're doing and they're finding the right way around that. And obviously the risk of our share price falling. Based on that pitch, has anyone got any questions or has anyone got any objections to putting that trade on? No? Cool. Did anybody have any time to think about any of our current open positions? Well, this is what we've got open at the minute. So we're doing pretty well.
Yeah, let's talk about the positions and maybe finish there.
Okay, so you guys can notice HSBA. That was negative before today. So that's a short. You know what a short is? Okay, huh? Do you want to say? Sure.
When you want the price of something to go
Down. Yeah, so we want the price of the stock to go down. So I can get into the details of shorting if you want, like how it works. Okay. No, fuck.
Sorry.
No, I'm joking. So basically, like, when you short a stock, you don't actually own it, you don't do anything with it. Basically what you do is you find a broker, so somebody else that owns the stock, so HSBC. So obviously this is all fake, so it's not really very perfect, but with this, if I was a real person, I want to short HSBC, I'd go to a broker, somebody that owns HSBC, and then they'd lend me that share in HSBC, so they've lent it to me. It's really weird to think about it. So they lend you the share, and then I then go to the market and I then sell that share in HSBC on the market for whatever price it is, 100 quid. So I sell it for 100 quid on the market. Then, at some point in the future, I've then got to give that share in HSBC back to the place that I borrowed it off. Yeah? Because you've got to give them back what you borrowed. So if the share price in HSBC in that time has gone up to £110, I've then got to buy that share back off the market for 110 quid, and then I then give it back to them. So I've lost £10. Yeah? But if the price of HSBC has gone down to £90, then when I go back to the market and buy it, so I can then give it back, I've bought it for 90 quid. But I've only got to obviously give that share back to them, so I've made 10 quid. Yeah? Yeah? Good? Yeah, does that make sense? Okay, it takes ages to, I still don't, it's probably took me ages to get my head around that. Anyway, does anyone know why that share has gone down loads today? No. Okay, so HSBC today announced that they're going to have loads of job cuts. They're cutting like 30,000 people over the next few years. Coming out.
Have they said anything about stuff in London or not?
Not specific. I don't think they've made any specific statements about where the jobs are going to be cut. Okay. I think maybe like the more investment banking side of things, market's not reacted very kindly to that, so the share price has gone down.
Which is a bit weird because unfortunately, I mean, we talked about that 2 weeks ago.
Yeah.
when a company speaks about job cuts,
Yeah.
the share price tends to go up,
Yeah.
unfortunately,
Yeah.
because I mean you are just cutting expenses, or
Yeah.
so you can make more money. I mean you don't have to pay the employees, so you can make more money, so you can make more earnings, and that means that the share price goes up,
Yeah.
which is a bit of a
I
weird
think
thing. But
here the reason why it's gone down is more just like the reason why they're doing the cuts,
okay.
because HSBC is very heavily exposed to Asia. Like I think 75% of their profit comes from Asia, so coronavirus has screwed them a bit there, and also their investment banking division is not very strong at all at the minute, so they're having to cut jobs there because of that.
So we also have to see the clients of the company we're investing in. It's like huge.
Yeah, it's the whole
You have to
network.
see everything,
Yeah,
the
you have
big
to see
picture.
Yeah. So to me, I don't know what Gonzalo thinks, what everybody else thinks, but like, the whole reason why we did that short was because of the whole Hong Kong riots last term,
Okay.
and we just kept it. I don't think that's going to fall by much more, and I think that's a good point to exit for me. Like we've made
Good. Let's do
€5,000.
it.
Let's
Let's do it.
So tomorrow I'll close that unless you guys have any objections. What do you
I
guys?
mean,
What do you guys
my
think? HSBC?
objection would be that it is our only short position,
Yeah.
which is not good,
No.
because I mean we are long more than 95% of
Yeah.
our portfolio is long, so
Yeah.
I wouldn't do that. I mean I would even short another stock or two, but
Yeah.
I mean if you think that we can take the profit, let's do it.
Yeah.
When you say go long, it's the
Buying
real
the stock,
buying.
yeah,
it's
correct.
not just borrowing. It's like
No,
real
buying.
Go
buying. and
short
Is the opposite.
is
Cool.
the opposite.
Good little point about shorting and longing that you might find interesting is that what do you think's got more risk to shorting a stock or going long on a stock?
What's long?
Long is like buying it, so you buy it, so you want it to price go up, or the price to go, or you want the price to go down.
What is riskier?
What's riskier, short or?
What do you think? Why?
Do you think long?
Long.
Why do you think long's riskier?
No.
Because it's
no.
more unlikely for the companies to increase their share price.
Okay. What do you think?
I think go long because it's just more common.
Okay. What do you think? Long or short?
Depends if they are a short company.
Yeah. Okay. So the answer is it's more risky to go short all the time because it's very, very easy for you to get wiped out completely and you lose all of your money. Because, so as I was saying earlier, so share price is £100 and you go short on something, yeah? It's pretty possible that that share price could go up to £200 and you've lost everything, lost all £100, yeah? But if you're going long on that company, wait, how do I explain this?
Your maximum loss.
Yeah, so yeah, your maximum loss is 100%, and your maximum gain is also 100%. Because if that share price falls right down to zero, all you can gain is 100% of that, right? You can only gain or not even 100%, like 99.99%. But if you go long on something like Tesla, for example, you can make hundreds and hundreds and hundreds of percent.
If you go short, you even have to pay additional to what you.
You normally pay the same fee if you buy the share or if you sell the share. You normally pay the same fee.
For example, if you go short, you buy at 100, and then it goes to 200. Now you have to pay back.
Yeah, you need to
200.
pay. I mean,
It's like an additional fee. It's an additional cost.
yes, I mean you are losing all your money in that case.
All your
So
money and even more. No?
yes, because
Sorry, I
you-
didn't hear the question.
If you go short
Yeah.
on something, like you buy the asset at 100,
Yeah.
and then it goes at, for example, 150,
Yeah.
now you have to pay back 100, like the first thing, and also 50.
No. So when
Only 50.
so when you borrow when you borrow the stock, like you borrow it off somebody, you've sold it. So then you've sold it, so you've got 100 quid in your account, and then when you then buy it back, you've got to buy it back for 150. So you've already got 100 in your bank because you've sold it already. And then when you buy it back off the market, you're paying 150. So then your overall loss is 50.
Oh, okay.
Yeah. But yeah, basically the point here is like, so look, if you bought Tesla in like 2013, it's $40. Now it's sold way up to like $850. So you've made hundreds and hundreds of percent. Whereas if you then if you buy something that's going to go down in price, you can only make 100% maximum. So there's less what's the word, upside potential. Yeah. Okay. I'm a bit conscious of time because we've run over a bit, so I don't really know. Maybe we should call it a day, Gonzalo. I don't know.
Yes.
Yeah.
Is there anything else in the?
Yeah. So I'll get that HSBC closed, and I'll put the Rathbones one on. Is there
How
anything?
about that Lloyds Bank? We
Yeah.
have the same reasoning with HSBC. How about that?
Yeah.
No, but we have the stop loss there still, I guess.
Yes.
It's going down, so can we place it short?
We could.
So if we wanted to do that, we'd have to obviously close our position there, and then if we think, that's obviously assuming that we think it's going to keep going down,
Yes, we could.
and then that would be like realising our losses as well. Like if we keep this going and it suddenly goes up again, then we obviously not lost our money anymore.
Is the reason why Lloyd's performing badly is the store closures, like outlets closures?
Yeah, a lot of that, and just like Brexit uncertainty, like a lot of the UK banks aren't performing very well at the minute. They had a bit of a rally after the general election, but then like with Brexit and actually I've got it's in my news slide that we've not actually managed to get to, but so on the 11th of March is like the UK budget, which will probably affect Lloyds a fair bit. There's possibility of
For
like
the good or for the bad?
probably for about
She's here.
I don't know. It's just like the Chancellor basically going to say, oh, we're going to spend money here, we're going to increase taxes here. So I mean, if he increases, I don't think it'll affect Lloyds too much. I don't know. He could end up increasing corporation tax or income tax or something like that. We don't really know. But it's a big sort of indicator to markets. And then yeah, just coronavirus. Don't know if you read about Apple having to like revise down their revenue and profits. German investor sentiment's gone down because of it as well.
Yeah, this morning, no?
Yeah. So, is there anything that you guys want us to like cover in future meetings that we can? I don't know what's best for you. What do you think? What do you like us to go through? Because I mean, you guys are here now, so.
I don't know if I'm allowed to do this suggestion, but
Yeah.
can we do like more practice, like bring our laptops and?
Oh yeah, sure, absolutely. Yeah.
Thank you.
Okay. So do you want to? Would you rather us do that rather than waffle on about?
This is also like this,
I think
these are the
that'd be
basics. So
Yeah. Yeah, sure. Shall we like so what we'll do another one in like 2 weeks. Shall we like basically just get up exam and or just go on our laptops and just like walk through? Exactly
I
how it
think maybe
works.
like a few slides on this, like the brief ideas that you guys want to talk to us about, and
Yeah.
we get on exam.
And then you guys get on that and then we'll
Yeah.
just ask us questions. That sounds perfectly fine with me. Cool. We'll do that next time.
Thank
Cool,
you
thanks for
very
coming.
much. Thank
Cheers.
you.
Thank you.